What's up, guys? I'm Brian Prahl with the Palmetto Mortgage Group. I have with me today Jonathan Mauffray. He is a financial advisor with Edward Jones, somebody that I trust, somebody that I think is very smart, and somebody that I think can give really good advice. And the thought was, we're in some uncertain times now, not only with COVID-19, but the result of that has been some market volatility, some extreme market volatility. I'm not sure if any of you have looked at your IRAs or your 401ks over the last couple of months, but if you haven't, I would certainly advise not doing that right now. I think you'll be sorely disappointed. But then the thought came, let's see if we can't get somebody that we know knows the markets and has good advice on with us to give you guys some advice on some things you can do to A, protect your investments and your net worth, and then B, use these times as an opportunity to grow your net worth. So that's what we wanted to do today. And Jonathan, man, I really appreciate you being on with us.
Well, thank you for having me, Brian. I appreciate the time to be here. So a few things I wanted to look at and explain, or just kind of look at where we were in the market, where we are currently in the market, and look at a few opportunities that people may be able to take advantage of this fluctuation that's going on in the market. So first of all, understanding where we were. As recently as 2 months ago, on February 19th, the S&P 500 was at an all-time high. Unemployment was at a 50-year low. Wages were up. People were making more money today than they ever have before. Corporate earnings were good. GDP was good, on track for around 4%. Household debt was at an all-time low, while household net worth was at an all-time high. Price of oil was trading around $60 per barrel. Inflation was relatively low. Interest rates were relatively low. Around 10-year treasury was around 2%. So for lack of better words, everything was good. And where we are today. So what happened was coronavirus turned into a global pandemic. The government basically created a self-imposed lockdown of the entire country. That caused a 34% drop in the stock market. Unemployment is likely to go to 20 to 30%. And it's really an unknown of how long it's going to take to return to some type of normalcy. One thing to really understand is that these drops are not abnormal. Since 1900, the S&P 500 has dropped more than 20%, 32 times. So on average, they happen about once every 3.5 years. And the things that cause them to drop are unknown. We never know when they're going to drop. But that does create some opportunities. There's an old adage when it comes to investing that says you should buy low and sell high. And one of the richest men in the world says you should be greedy when others are fearful and fearful when others are greedy. So two strategies that I'm doing with my clients right now to look at opportunities and to take advantage of the downturn are, one, if you already have money invested with an advisor, to rebalance your existing portfolios. The stock market has dropped, but some of the bonds have held their values. So it's a great opportunity to rebalance and sell some investments that are high and buy some investments that are low. The second strategy I'm doing with a lot of clients that have new money coming in is doing what's called dollar cost averaging. And that's basically where you have a set amount to invest and you take a little bit of money, a set amount every single month, and buy some of the same investments. So it's kind of like taking a bite of the apple, one bite every single month for about the next 6 months or a year, whatever time period you're comfortable with. There are several opportunities in the marketplace right now. One idea just wanted to share with you, and this is why it's important to work with an advisor. This is the company I'm sharing with a lot of clients right now. It's the largest beer maker in the world. It's one of the world's top 5 consumer companies, so very, very large. They own 5 of the top 10 beer brands, and they have 18 brands that have sales over $1 billion. So the likelihood of them getting through this pandemic is pretty strong. Some of their brands you're probably familiar with is Bud Light, Mick Ultra, Budweiser. For any of your agents that are out in Pillion or Gilbert, they own Bush and Natural Light, Stella Artois, and dare I say, they also have Corona. But the stock, I looked at, it was over a year ago, it was trading about $100 a share, and the stock has dropped roughly 55% in the last year. So it's now trading around $42 to $43 a share. So buying some of that now, because people, even though they're in a lockdown, they're still buying beer and drinking beer. You can buy it now.
Now than ever.
Yeah. So buying it at $43 a share, you didn't have to ride the roller coaster down. And at some point, this pandemic, the concerns, the fear will end. People will get back to work. Restaurants will start buying more beer. The stock price will eventually go up. May take a year, may take 2 years. But if you can double your money in a 2 or 3 year time period, it's a pretty quality investment.
What's the name of the company you said?
So Anheuser-Busch is the name of the company. The ticker is BUD, old Bud.
So the best part about that idea, and I'm sorry to cut you off, man, but
yeah.
So you buy stock in the company, and then you can help the stock price by helping yourself manage through quarantine by going and buying some beer and having a good time.
I know a lot of people who drink Mick Ultra. They drink Bud Light. Don't know very many that drink Budweiser anymore, but that's a true statement. And while you wait for the stock price to go up, it also pays this thing called a dividend. So a dividend is return of profits back to shareholders. Acts very similar to rental income. So for the real estate agents that have the house, rents it out, gets that rental income, the dividend on Bud is right now close to 5%. So it's paying you income while you wait for it to go up. Some other opportunities that I look at in the market, I think it's a great time right now just because it's a great lesson to teach everyone about law of supply and demand. The price of oil has dropped about 75% since January 1 of this year. And the reason why is because there's no global demand right now. There's an abundant amount of supply. But that has created some great opportunities in the oil markets. And I'm recommending a lot of clients, we want to stick to quality on those. So stick to some of the larger companies like your Chevrons, Royal Dutch Shell, even Exxon. These companies are paying really good dividends. And some other sectors, healthcare, financials, technology, it's literally right now, it's like a cookie jar if you're trying to find some good investments to grow your money over the next time periods.
So back to the Buffett quote, I think it was Buffett, be fearful when others are greedy and fearful. What you're seeing now in this type of market is that a lot of people are very fearful. Is that correct?
Yes, it's huge fear. When you're seeing your retirement account, go down 15, 20, 30%, it's, oh my gosh, get me out. I don't want to lose one more dime. And that's what's causing a lot of the panic in the markets to be as crazy as they are, is that fear.
One of the things that you and I talked about that I learned from you, and I forget what you called it, but maybe tax loss harvesting or something like that.
Yeah.
And so you will explain that better than me, but basically if you have, let's just use a financial, let's say you own Wells Fargo and Wells Fargo dropped a significant percent, then it might make sense to go ahead and sell that, take the loss, but reinvest that money back into another financial sector stock to ride the wave back up. So you get the tax benefit of selling at a loss, but also reinvesting the money in the same sector. Is that accurate? Yep.
That's exactly what we're doing with a lot of clients that say you've got money, but it's not in a retirement account. So it's a great time to right now harvest a tax loss to take advantage of the opportunity of the exact same scenario you just mentioned. You had a Wells Fargo, it's down, get out of Wells Fargo. There's a lot of companies, whether it be BB&T, Bank of America, JP Morgan, Citigroup, they're all in the same financial services sector, and they will go up. Another quote by Buffett is that all ships go up with a rising tide. So buying another company within the same sector is a great idea to harvest that tax loss, because at some point you're going to have gains.
So I've heard a lot of people talk about how they think we've hit the bottom. I know you can't predict the future, but if you did have a crystal ball, what's it saying about where we are now versus where we could be in a couple of months?
So, without a crystal ball, I got to tell you, I like where we are now. I don't know where the bottom is, and certainly we're going to see some more volatility. This isn't over. However, there's a lot of things that have been done with this recent correction to help stimulate the market and the economy that didn't happen back in 2008, didn't happen back in 1929. So the Fed is committed, and they pumped about $2.5 trillion so far into the market. Probably going to commit another $2 trillion into the market. Was that Chick-fil-A? I'm hungry too.
I got my food delivery.
So I say that to say that the current leadership that we have in the country is committed to, the government forced this shutdown, but the government is committed to seeing this thing recover. And not to be political, but it is an election year. So the last thing that current leadership wants is for everything to just crash, before we all go vote in November. So they're doing a lot of things to help stimulate this recovery. And once again, we will recover. We just don't know exactly when or how long this is going to take. No one has all those answers, but we will come back.
So I don't want to run too long here, but I was going to ask you, and I don't know if you have your finger on the pulse of real estate at all, but a lot of the people that would likely watch this video, this interview between you and I, are going to be real estate agents. And I'm sure they have questions about what real estate, effects would have as a result of this. So do you have any thoughts on that?
Yeah. So, we follow and kind of track the real estate market because that's one of the 10 leading indicators of the economy. And if we're heading into a recession, this recession, if you will, that we're in right now is basically caused by the government. So it's not your typical recession where we saw it coming because housing stopped. So we're still looking at housing permits, which are actually still continuing to grow even in this bad market. So we're looking at kind of the same thing in the real estate market, the supply and demand. People are still looking at houses. We do think it is going to slow down, obviously, in for the next couple of months, next quarter. A lot of the closes and a lot of the sales we saw this year, or should be last month actually, were all from places or all from things that they did a month and 2 months ago. So obviously that is going to slow down, but that will ramp back up, and hopefully once again the country's back up and running in June and July. And I know typically a lot of people move in those certain months, but the permits for the housing starts are actually all still really good. We hadn't seen a huge drop off in those, but the housing sector is one we do look at as one of the leading indicators. And the housing market still looks good right now.
Yeah. It's funny. And I do have some thoughts on that as well, but the difference between 2020 and 2008 is that, you mentioned it earlier in our talk was, household net worth is at all-time highs, which the biggest driver of American household net worth is home equity. And so people have equity in their homes, which means the difference between now and 2008, back then they were over leveraged on their property. And then when their income drops, they're going to walk away from the house because they have no stake in it. Well, now if you're in a position where you've got 20% equity in your home, you're not going to leave that net worth on the table and walk away. You may decide to hold off on listing your house because with jobless claims being as high as they have been, you might have a limited buyer pool, but that's only going to create a shortage of supply, which means values will remain relatively constant. And so on top of that, just on the human nature side of it, you got the emotional, drain of being stuck at home all the time. You're going to want to get out, and you might even realize that you're in a house that doesn't quite suit your needs going forward in a post-pandemic world. Do you agree or disagree with that?
Completely agree. Those are all great statements. And just once again, to reiterate, this is not a systemic financial crisis that we're in. So household net worth is exactly what you said. And that is, and it just came out maybe 2 weeks ago about the average price per sale on the house, but it was actually up. So we think one of the reasons it is up and growing year over year is because of that supply and demand. So hopefully that's that's good for the real estate agents. Sure. I know it's tough because they can't get out and show houses right now, but this will pass.
So just to recap, then you've mentioned a couple really good points, and one of them was the tax harvesting. One of them is looking for opportunities, and you gave us an idea on Anheuser-Busch, which obviously many of us would have a vested interest in the improvement of the stock price anyway.
Yeah.
And what else did you say? Recap for me.
So I looked at some other opportunities in the financial services sector. So I looked at even healthcare, because healthcare also took a big hit because a lot of people aren't going in for a lot of the particular services, but that will come back. So it's a great opportunity to buy at low prices. I looked at also the technology sector. Just what we're doing right now. This is technology. This is how the future is coming. So it's a great idea to invest in maybe some cloud companies, or a Cisco that does a lot of the WebEx. And I'm not sure what else we had talked about.
Yeah, no, that covered just about everything. You mentioned oil, I believe, as
Yes,
but with quality oil, not your smaller companies there.
Correct.
Well, Jonathan, man, I really appreciate you taking the time to do this. I know you're busy and you're taking phone calls all day long, so I absolutely appreciate your time helping me out with this, man.
Well, thanks for having me. I appreciate it. Take care,
listen, guys, Jonathan is a trusted partner of mine. I've worked with him for years. I think he's great. I don't want to push Edward Jones or Jonathan Mauffray on you, but if you don't have an advisor and you do want to reach out to somebody for some advice, or maybe even to manage a portfolio for you, Jonathan's phone number is here on the video. So please do reach out to him. He's awesome. He's helped me and grow my portfolio. I don't want to give specifics, but we've significantly beat the S&P over the last 7 or 8 years. So just take that for what it's worth. And I wish you all the best of luck. And Jonathan, again, thank you, man.
Thanks, Brian. Take care, man.